The Federal Reserve raises interest rates for the first time since 2018. The Federal Reserve raised interest rates Wednesday for the first time since 2018, kickstarting its efforts to tackle the country's highest inflation in 4 decades. The central bank raised its benchmark rate by a quarter percentage point, marking the beginning of the end of the ultra-easy money policies that have been in place since the early days of the pandemic. Additional rate hikes are likely to follow in the coming months. On average, Fed policymakers said they expect interest rates, which have been near zero, to climb to around 1.9% by the end of this year. "We need to move away from very low interest rates," Fed Chairman Jerome Powell told lawmakers earlier this month. "They're not appropriate for the current situation in the economy." Annual inflation reached 7.9% last month, reflecting the steepest rise in prices since 1982. Price increases have proven larger and more long-lasting than the Fed expected, as businesses struggle to keep pace with surging consumer demand. "Inflation is all too high," Powell said. "We're going to use our tools to bring it down." The Fed faces a tricky balance. The central bank is walking a tightrope, though. Officials hope to tamp down spending just enough to bring prices under control without tipping the economy into recession. That balancing act was made even tougher by Russia's invasion of Ukraine, which triggered a sharp jump in gasoline and grain prices. Those increases are further raising inflation prospects in the near term, while also threatening to slow economic growth. The invasion of Ukraine by Russia is causing tremendous human and economic hardship, the Fed's rate-setting committee said in a statement. The implications for the U.S. economy are highly uncertain, but in the near term the invasion and related events are likely to create additional upward pressure on inflation and weigh on economic activity. Fed policymakers lowered their forecast for economic growth this year to 2.8%, down from 4% that was projected in December. The more money consumers are pouring into the gas tank, the more money that's being spent at the grocery store, the less money that's available for other discretionary spending, said Greg McBride, chief financial analyst at Bankrate.com. The Commerce Department reported Wednesday that consumer spending at gas stations jumped 5.3% last month, while retail sales elsewhere declined. While the Fed's initial rate hike was modest, Powell said larger and more frequent increases could follow, if inflation doesn't begin to decline soon, as officials expect. One member of the rate-setting committee, St. Louis Fed Bank President James Bullard, wanted to raise rates by a half percentage point on Wednesday,